All right. Now, yesterday we saw something really interesting happen. The S&P 500 closed below its 200-day moving average for the first time since June 2016. What is your perspective on this? Is this a really important signal? Does this show that there's a trend change happening?
Now, was that the exponential moving average or the simple moving average? I'm just kidding. I'm just
Okay.
kidding. It was
I would
it
not
was
know
the
that.
It was actually the simple moving average.
Okay.
I guess part of my reason for responding with that particular question is it kind of, for me, I sort of, I'm somewhat dismissive of these quote unquote marquee technical levels that everyone watches. And I mean, to be sure, hedge fund algos key off these moving averages and pivots and Fibonacci retracement lines and whatever crazy machination of all of the above that the PhDs who work for the hedge funds come up with mathematically. It just actually closed barely below the 200-day moving average,
Right.
and it's as of right now,
Slightly
it's
above, I think. It's like
e-
right on the line. Yeah.
yeah. Actually, the S&P's pulled back since we started
Oh,
our
okay.
conversation, so it's below it again.
Right.
I mean, for me, for something like that to be technically significant, and again, I'm primarily a fundamental analyst. I'm not a technician, but we have to pay attention to technicians because, a large portion of the market trades off of it. So, um, if the 200-day move, if it close below the 200-day moving average is going to be significant, in my opinion, it has to not only close below the 200-day moving average, but it has to stay below it. So today it popped back above it intraday. We'll see if it closes below it, at the end of the day. And again, if it's just 2 or 3 days of closing below it and then they pop it back above it and it's off to the races, obviously the close below the 200-day moving average was not significant. However, if it kind of treads water below the 200-day moving average and on days when the market rallies, it kind of bumps its head from below on the 200-day moving average. Then I think, now I'm talking about I want to see 2 or 3 weeks of trading activity before we can really decide if the close below the 200-day moving average was meaningful or not. It could be technically meaningful, but again, I think just a 1 day close below it is for me the jury's still out. I just wanted to mention really quickly because it's now if you have on the financial networks, CNBC or Bloomberg or Fox Business, every time the market is at a level where it's 10% below its all-time high, newsflash, Dow now in correction territory. And for me, I think that's really idiotic. I don't think that's a technical level at all. I think the 200-day moving average is much more impactful in terms of how short-term traders dictate their trading. To me, I think it just is kind of silly. Like, who decided that a 10% sell-off in the Dow or the S&P is all of a sudden considered a correction? I mean, it's absurd. So I just had to throw that in there because it's been annoying the crap out of me the last couple of weeks.
Now, a trend change that actually you do see happening right now is with respect to the economy. You think the economy is slowing down, and one of the big reasons for this is the leverage of the average household. They're running up against their ability to support more debt, you've said. And, debt issuance really has created a lot of this consumer spending, housing purchases, retail sales that's really boosted the economy. And now the ability to take on more debt is really slowing down for the average household, and that's slowing the economy. Can you expand on that?
Sure. And I've been writing about this in my short sellers journal for several weeks now. And it just if you look at the debt numbers, the credit card numbers, auto debt numbers, I don't even really look at student loan debt, although it's obviously a huge problem. I just look at the debt that the average household takes on to pay expenses or to buy a car or to buy furniture or whatever. And I do think we're at the point, and you can look at that. The St. Louis Fred website has household interest payment numbers and things like that, and you can run interest payment as a ratio of disposable income, and we're at by far all-time highs in terms of interest payment as a proportion of disposable income. And disposable income here is not your income after you buy all your necessities. Disposable income is defined as your after-tax income before you spend any money. And we've, especially in the housing market and with auto debt, we've just gone through a 4 or 5 year period where we've had a massive run up in household debt, and especially like with home buying, first time buyers, they've maxed out the size of the mortgage that they can take out based on their monthly income and their ability to service the mortgage. And at some point, I think these households get pushed over the edge and you start seeing defaults. And we're starting to see a big tick up in default rates in credit card debt and auto debt. And believe it or not, and you won't read this in the mainstream media, but mortgage debt delinquency rates are also starting to tick up again. And it's certainly something to watch. So I think to the extent that the economy or economic activity in general was driven by the average household's ability to assume debt in order to spend money and consume, I think we're kind of at a wall there. We've hit a wall, and I think that on average and in general, the average household really can't support any more debt than is out there now. And I think we're going to start to really see the economy stall out. We've seen that. I haven't seen the auto sales numbers yet today, because I've been kind of in and out of the office. But we've certainly seen that in the trend of auto sales, retail sales. We had 3 months in a row of retail sales declines. That's big, especially when one of the months was December. And also, if you unwind the seasonally adjusted annualized rate numbers that are published by the National Association of Realtors and the Census Bureau, which reports new home sales, housing sales have started to plateau, and I think they're going to start going into a downtrend here.
Now, with respect to the economy, you've talked about also there are these trade wars going on, but really when we're approaching, another economic crisis, trade wars are not the wars that we should be worried about, you say?
Yes. Just in my sort of, I guess, call it superficial knowledge of the history of humanity, it seems like trade wars crop up when countries are under economic stress. And to me, most major wars, if not all major wars throughout history, are seated in economics. So countries starting to collapse economically, and they go on an imperialistic spree and try to annex the economic wealth of other countries. And I think that's what we're seeing here. I think that's a big part of what we're seeing in the United States belligerence towards the various Eastern Hemisphere countries. It's belligerence in the Middle East. And I think the trade wars are really more a symptom of that. And I think it's a symptom of underlying economic turmoil that's going on inside the country. And so, when the financial media blames the sell-off in the stock market on the trade wars, that might have been sort of a trigger event, the straw that broke the camel's back, but we're talking about right now the most overvalued stock market in the history of this country. And that's really why the stock market's going down. Whatever the cause, whether it's the trade war or, the problems Facebook is having, something something got the market to focus on the fact that stocks are insanely overvalued, and I think that's why we're seeing the sell-off in the stock market.
Now, what is your perspective on then what people should be concerned about currently, if it's not the trade wars?
Well, I think you got to be concerned about managing your household finances, and I think, again, I've been writing about this in the Short Sellers Journal. I think that we're entering a trend now in the markets where hedge fund algos are starting to sell the rallies, and they may buy the sell-offs, for a trading bounce, but rallies are being sold rather than when you break through technical levels, hedge funds and algos were piling into the stock market. Now I think we're seeing the reverse of that. And I think that the smart money is trying to get out of the stock market without causing, a rush to the exits by everyone. And so I think, having said that, I think what you need to be concerned about is more preserving what you might have already made in the stock market. In other words, I'd get out of the stock market right now.
Now, do you think right now is the time to invest then in precious metals, if we want to turn to that?
I mean, I hate being called a gold bug, but that's what I'm doing with my extra cash flow. I'm buying silver, I'm buying gold. In fact, SD Bullion was running a special a couple of weeks ago where they were offering 20, and I'm not getting paid to do this, isn't a promo for SD Bullion, but for me, it's the type of thing I take advantage of. They were selling 20 Austrian 1-ounce silver Philharmonics for the price of 19. It's like, I mean, at the time, I didn't have a lot of free cash on hand, but I'm like, I can't let that go by, so I bought some. Yeah, I mean, I think right now we're at a historical low point in relative to everything else in the precious metals. In other words, I think relative to everything else, the precious metals are historically cheap. And I think at some point you're going to see a lot of money that comes out of the stock market go into the precious metals. Now, I'm not saying put all your money in precious metals. Some of it you might want to just hold in cash. I don't like to hold cash because I just don't trust the U.S. dollar. But if there's any people out there who have very sophisticated trading accounts, buy Russian bonds. And Jim Rogers had mentioned that on the Metals and Markets interview last Friday. And he's been buying Russian bonds for quite some time, actually. I don't know what they're yielding right now, but I had actually suggested to some people, I don't know, it was probably about 2 years ago, Russian bonds were yielding 10%. I'm like, if I had a big sophisticated hedge fund instead of the one I have, I'd be putting money in Russian bonds right now. So, things like that. I just don't think that you're going to be happy a year from now if you leave your money in the U.S. stock market.
Now, with respect to also mining stocks, can you give us an update for our viewers where you see those going in the short term?
Again, it's to the extent that gold and silver are historically cheap relative to all other asset classes out there. Obviously, they're not historically cheap on a price basis, but the mining stocks are even cheaper than gold and silver. And the mining stocks, I mean, especially the juniors. Some of the juniors have been getting really beaten up in the last several weeks. I think that putting some high quality junior mining stocks and some of the better quality larger cap mining stocks into your portfolio right now, I think it'll pay off. It's not going to pay off immediately, and again, if we get these periods where we get a huge drop in the stock market, you're probably going to see gold and silver and the mining stocks go down briefly with the stock market, but they'll bounce right back. In fact, I think it was it yesterday or Thursday? I think it was yesterday. Gold was up like $15 while the stock market was getting hammered, and that's flight to quality. That's the kind of flight to quality that I think we're going to start to see, because I think that to the extent that smart money is working their way out of this stock market, I think one of the things that they're doing with their cash, besides holding probably T-bills, is buying precious metals and mining stocks.
No, actually, just one last topic I'd like to discuss before we let you go. You also reported about this on your website. It was about the Trump administration, how he's, firing some top people and introducing a lot of hawkish people. And how do you think that'll play out?
Again, it gets back to this issue of it's not trade wars that we should be worried about. It's military wars that we should be worried about. And in particular, the appointment of John Bolton is to me, I don't think he's ever seen a country that he doesn't want to drop a nuke on, except maybe England cabinet. So to me, it's very, very troubling that Trump has populated his cabinet now, replaced his original appointments, and populated his cabinet with war hawks, and that has a good possibility of not ending well.
Now, what is the action that our viewers then should take in preparation? I mean, is there any is this information, can they use it in any way?
Yeah, go out and try and find some cyanide just in case. No, again, do I think there's going to be a nuclear conflict? I give it less than a 30% chance, but that may be the hopeful me. Again, I think it just sort of speaks to we're entering into a period of time when I think you've got to be cognizant of your household finances and sort of just manage your own affairs, and don't worry about getting rich at this point. It's I think it was Mark Twain who said it. I'm not concerned about the return on my money. I'm concerned about the return of my money. Well, to me, that means get your money out of the stock market. Buy some precious metals. If you want to buy some cryptocurrencies because you think those are going to help protect your wealth, buy some of those. I just think we're at the point now where you got to be leery about what's going on out there, and manage your household and your family accordingly.